IFRS S1 and S2 Essentials. We heartily welcome today's speaker, C. Arun, Kumar, Rajagopalan. Please raise to the motto song. Be seated. Please play off our video.
Arthashastram, Dharmashastram cha, mean economic principles, Arth, and ethical considerations, Dharma, which are central to the work of accountants. The entire world is deliberating about impact of climate change coupled with disruptions of artificial intelligence. India has given philosophy of Vasudhaiva Kutumbakam to the world and successfully hosted G20 summit on this theme and also launched Global Biofuels Alliance. The accounting profession also has an enormous responsibility to guide the work, where accountability meets innovation so that vision can be converted into solution. The Institute of Chartered Accountants of India, being the world's largest accounting body after the successful hosting of WCOA 2022 and GLOBAC, proudly presents before the world World Forum of Accountants 2025. Where accountability meets innovation for a sustainable planet. The world's brightest minds will exchange insights, explore emerging trends, and unlock the possibilities for the profession, where foundation will be laid to shape the vision for the future of accounting profession. Hosted at Yashobhoomi, the largest convention and exhibition center in the heart of India's capital, New Delhi, inaugurated by the Honorable Prime Minister Shri Narendra Modi, is all set to host the congregation of accountants from around the world. And while you're here, experience the vibrant culture and heritage of New Delhi, a city where history meets modernity, offering unforgettable memories.
World Forum of Accountants, an experience of 3 days, insightful discussion, groundbreaking innovations, and unparalleled networking opportunities.
With immense pride, we invite you to WOFA 2025, taking place, happening from January 31st to February 2nd, 2025, at the magnificent Yashobhoomi, New Delhi. Experience 3 days of insightful discussions, groundbreaking innovations, and unparalleled networking opportunities. World Forum of Accountants 2025 is where you need to be, where accountability meets innovation, AI for a sustainable planet. Join us at WOFA 2025 from January 31st to February 2nd, 2025 at Yashobhoomi, New Delhi. For more details, visit wofa.icai.org.
We request CA Abhishek Kothari to introduce about this speaker.
everyone. Today's topic is sustainability reporting on IFRS S1 and S2 essentials. We'll be hearing from Mr. Arun, who is our today's speaker. Introducing him, Arun is a partner with the Assurance line of service in Chennai. He leads ESG related reporting initiative from Chennai and has worked with numerous companies in assisting them with preparation of integrated report, BRSR and GRI reporting. He also advises companies on the CSRD reporting framework prepared in accordance with European sustainability reporting standards. He has extensively worked on sustainability reporting framework and ESG assurance audits for diverse sectors such as mining, automobile and spare parts, chemical manufacturing, pharmaceuticals, leading hospitals, consumer goods and other technology or service industries. He is engagement partner on financial statement audit of listed companies and other multinational companies. Arun is certified instructor on Ind AS and conducts various training sessions and has contributed to thought leadership publication on Ind AS. He has also conducted workshop on specific accounting topics for clients across India and spoken on various accounting and regulatory topics under the auspices of SIRC of Institute of Chartered Accountants of India. Thank you.
Thank you, sir. We request CA Krishna Kumar to present memento to speaker. Handed over to speaker.
Sustainability in itself is a very emerging topic, given the focus that a lot of countries have, typically also when you start with the country and then it kind of percolates down to companies and investors, employees, customers, the different stakeholders who manifested over a period of time, focusing on sustainability as a subject matter. And with that in mind, obviously regulators have also been pretty, shall I say, working overtime to kind of come up with various regulations across the globe. India obviously has its own sets of regulations in terms of disclosure requirements for ESG under the shall I say, ambit of BRSR, which is Business Responsibility and Sustainability Reporting for listed entities in India. That's typically one which is drawn inspiration from or rework based on a lot of international requirements and framework, typically the GRI, the UN SDG goals, and likewise there has been a multitude of regulatory, shall I say, frameworks which have emerged over a period of time. I thought I'll give you a genesis before jumping into one of the new kids of the block, which is the ISSP standards. So if you look into the overall standards or frameworks that companies have been following over a period of time, GRI, Global Reporting Initiative, is one which is being used by many companies over a period of time. And still they continue to use that across the board. It is if you were to draw a parallel, it is, shall I say, a parallel to the accounting standards that we have to prepare financial statements. So a lot of companies which prepare a sustainability report would typically use GRI based framework to kind of report on various matters related to E, S and G of sustainability. Of course, US came up with their own SEC guidelines. It was debated for a period of time. It was in draft for a long period of time. When it did come out, it was kind of challenged, and then so it's still not effective, and and kind of subject to, shall I say, challenge in courts of law in the United States of America. Of course, there have been other compliance requirements that have kicked in Europe, which is called as CSRD, Corporate Sustainable Reporting Directive, that is coming under the auspices of the IFRAC, which is the European Union's regulatory authority, which have come up with something called a CSRD, which again is based on a glide path in terms of based on certain thresholds. Be it if you're a public interest entity, or are you actually an entity with an asset background of $25 million, 25 million euros, turnover of 50 million euros or 250 employees. So that's another body which has come, which has really kicked in furiously in Europe, and a lot of companies in Europe are looking at it. And it's just not companies in Europe, but also companies which are operating in Europe, having operations in Europe, domiciled in India, having a subsidiary there or branch there, will also be applicable. And some of those will also be staged over a period of time, starting from 2025. And with all of these standards in play, IFRS Foundation also came up with their own standards, which is the International Sustainability Standards Board, part of IFRS Foundation, came up with their own standards pretty recently, which are S1 and S2. And these again are guiding principles for companies which wish to follow these standards at this point in time. Again, these have to be country-wide adopted. Many countries have, which also follow IFRS, have been adopting it in a very staged manner. A lot of countries have been, bringing this as part of their own law to kind of adopt over a period of time. But regardless, you could still voluntarily adopt, as is the case with many of the other standards, which is the GRI standards and others. And then if I were to step back a bit in terms of, while there are plethora of, or multitude of regulators, there have also been, shall I say, convergence of or consolidation of regulators. So within even IFRS Foundation, and many of you would have heard of or view or kind of read integrated reports. So a lot of companies come up with their annual reports, which are integrated reports, which typically cover just not the financial statement aspects of it, but also the non-financial information part of it. The integrated report was prepared under the framework of IIRC, International Integrated Reporting Council. But there was a consolidation, so it became Value Foundation. Value Foundation then got merged into IFRS Foundation. We've had TCFD, which is another disclosure task force for climate-related financial disclosures, which is pretty much a benchmark which a lot of companies use when they want to discuss about climate risk, when they want to kind of report on what are the challenges that are emanating in terms of companies' operations vis-a-vis the climate risk current and in future. So that again got merged into the IFRS Foundation. And likewise SASB. SASB is a US-based sustainability accounting standards board, which again has close to around 77 industry-specific standards. So that again got merged into IFRS Foundation. So I think there has also been a fair bit of consolidation of regulatory authorities and standard setters, so as to ensure that companies don't face hardship in moving from one standard to another as and when required. And as we speak again with the European Sustainability Reporting Standards, ESRS, becoming the norm for most of the European companies, companies which were following GRI-based reporting now have to look into the incremental efforts, what are the additional disclosures that are required, and report on those from a CSRD standpoint. And so again, the GRI as a body and the CSRD have looked into interoperability. So when I say interoperability, they are trying to evaluate what are the disclosures that are being made in GRI and how does it relate to the shall I say, the disclosures that are required in the CSRD, and what is the incremental that is required. And likewise, there is a task force or working group that has been formed from an ISSB to a GRI and ISSB to CSRD standpoint. So while I think there have been mushrooming of standards and regulatory authorities over a period of time, There is also an acute awareness that it is going to put a lot of companies into hardship if they wish to move from one standard or a framework to another. And so these working groups and interoperability related papers have been coming out. You could actually Google them, and then you would find these interoperability documents being called out or available in public domain, be it between GRI and even our own BRSR, and likewise with respect to CSRD and ISSB standards. So these are some of the moving parts that we are seeing in the regulatory framework, which typically, shall I say, are the basis for companies which intend to report from a sustainability reporting standpoint. And so with that background in mind, maybe I'd like to walk you through in terms of what are the salient features of ISSB standards. These disclosure standards, as companies wish to adopt them or embrace them in their own reporting, what are the salient features that they should be mindful of as they embark on reporting basis this framework. So, if you look at it in terms of what is it in for professionals like us, what is there for companies, and what is the way forward. I mean, broadly, if you look into it, it gives companies opportunity to differentiate themselves in terms of their competitors, because today more and more companies, I'm sure you would have seen a lot of balance sheets, a lot of companies moving away from presenting just the statutory requirements of financial information and providing a lot more information in terms of the social aspects, the environmental aspects. There are pages dedicated as part of the annual reports which kind of call out all of these initiatives that the companies are doing. And so, obviously ISSB standards S1 and S2 will kind of only augment that further if there is because there is a method to madness in terms of what needs to be disclosed. And if those were to be followed, then that kind of also becomes a good differentiator from those companies and competition which don't necessarily report on any of those. So to that extent, obviously there is an opportunity to look at some of these frameworks and imbibe them in their financial reporting or their annual report, so to speak. Obviously for professionals like us, in practice it gives us an opportunity to learn, acquire a new skill, because some of this is complementary. I would say at the end of the day we are all accountants, so there is an innate sense of accounting involved in some of these disclosures, auditing these or advising clients in preparing these. So there is an opportunity clearly for us to ride the wave and understand what the requirements and assist clients in doing so. Similarly, from companies which are not directly impacted, it is an opportunity to kind of run a sustainability report, call out and attract talent, investors, and various other aspects in terms of projecting their own performance. And so, what are the things that become very relevant is, these are very topical, these are, things that have come up very recently, and so understanding them and appreciating them will be helpful for both for professionals, practicing professionals like us, or even companies which wish to kind of adopt these as well. And then you look into the road for the roadmap for the IFRS standards. I mean, it started some time back. I mean, while it is being finalized in 2023, exposure drafts came out in March 2022. There were consultations, public comments being sought. A lot of those were deliberated, and finally the standards came into play from 2023. But that said, it has its own applicability in terms of the periods, and we look into it. And typically, it is from accounting years beginning from 1st of January 2024. These standards have become applicable, and obviously, a voluntary early adoption was encouraged, but of course, we are beyond that stage now. And so, as it stands, these are applicable from 1st of January 2024 as well. And companies which wish to adopt, albeit voluntarily, could do so as it stands today. And when you look into the very broad level in terms of the standards itself, the overarching theme in which these standards have been developed, as I said, TCFD, which is the task force on maybe the task force on climate-related financial disclosures. This has been one of the benchmark for many companies, and if you look into even a lot of our Indian company corporates, they do have TCFD-based reporting, and even those being assured by external auditors. These typically are driven by these 4 pillars, and these 4 pillars have been imbibed into these standards as well, which is strategy, governance, risk management, and metrics and targets. So ideally, at the end of the day, companies which are evaluating climate risk from their own operations standpoint will probably evaluate and perform an assessment having regard to all of these, and then the disclosures will kick in based on these 4 pillars. And that has been pretty much drawn reference in the context of S1 and S2 standards, and this would be a constant for both these standards, where companies will have to disclose their strategy in terms of overall sustainability, risks and opportunities, what is the governance mechanism that they have in place, what is the risk management assessment in terms of various risks that have happened, and how does the risk management get triggered, what do they do in terms of assessing various sustainability related risks, and evaluating and coming out with metrics and targets. These are, some of them are voluntary, some of them are mandatory. It could come down to the standard, or companies may voluntarily set targets in terms of net zero commitment to say, company will become net zero by 2040. Some companies do that. Some companies talk about renewable energy, moving up the value chain to say that they will be 100% renewable, based on 100% renewable energy by a period of time. Or it could be even zero liquid discharge. There could be a lot of other aspects in terms of various various metrics, targets that companies may want to set up. And when you look into the standards, the architecture of the standards in itself, S1 is more from a general requirement in terms of disclosures of various aspects and facets of reporting which they need to be mindful of. Some of this I could loosely draw parallel to our AS1 or Ind AS 1, which has some preamble or the prelude to how financial statements needs to be presented in terms of fair presentation, materiality, relevance. So some of these topical aspects that we generally look into in preparation of financial statements get pretty much imbibed into the standard. And of course it has more to it, but largely it gives you a correlation in terms of what we are used to in terms of financial statements preparation. Of course, IFRS 2 is a topical standard. It talks about more in terms of climate-related disclosures. The S2 standard has various facets. Of course, harbors all these 4 pillars in terms of the requirements. But in doing so, it will also call out companies' own assessments in terms of various climate risks. How are these actually being visualized? What are the simulations and scenario analysis that the companies do, and how are they monitored and reported? So all of those goes into the S2 standard, and there are bright lines in terms of what needs to be reported, what is mandatory, what is recommendatory in nature. And of course there is the SASB standards, because I did mention briefly about the consolidation of TCFD, SASB, and as well as the Value Foundation, which is the Value Reporting Foundation, which is the integrated reporting related framework. SASB is also an integral part of ISB. So SASB, US standard setters generally have in the past as well always come up with industry-specific standards. While a lot of them move away from industry-specific standards, US is always, even from an accounting perspective, have always come up with industry-specific standards, be it for revenue recognition, more specifically for revenue recognition, I would say, where they would have specific guidance in terms of accounting for each of the industry. And this was similarly replicated in the context of sustainability standards as well. And so you would, there are roughly around 77 industries which have been identified from a sustainability accounting standards board, and they have clearly talked about or discussed in these standards about what are the innate risks that a particular industry has and what are the things that you need to follow. So that is again an area to reference. It's a good reference point, and some of these are mandatory in terms of assessing the risks and opportunities, because as you get into it, you would also evaluate the risks and opportunity from a sustainability lens standpoint of continuing a sustainable operation. And so for that, these standards will actually call out some of the inherent risks in a particular industry, and so to that extent that becomes a bit relevant to observe. And The connected information is a very key concept, which is nothing but to say that there is an interrelation or an interdependency between various aspects that are getting reported, be it within the sustainability standards, be it S1 and S2, or it could also link back to what is being reported for as a general purpose financial statements. The annual financial statements that the financial statements that are prepared may also have certain data which could be consistent with what is reported here. For example, it could be in terms of the group in itself, whether the structure of the group, subsidiaries in place. It could also be in terms of consumptions, which you have details of consumption of various items, and then how does it actually filter here. So there could be a lot of interconnections that could be established, and so it is important to ensure that the consistency in terms of what is reported across different financial statements and non-financial information is appropriately tagged and evaluated. So this is broadly, I would say, the core edifice or the structure on which the standards are developed, and gives you a bit of a bird's eye view of how this was actually constructed over a period of time. So moving on to the specific standard in itself, S1. If you look into the general requirements for disclosure of the sustainability information, I mean, there, of course, as is the case with any standard, it has various aspects of reporting. But if you look into the general requirements, and then you can get into some of the specific requirements, and then the transition provisions and all of those, it is pretty much for a primary user of a general purpose financial reporting. So one of the things that people have to bear in mind is when you look into some of the other standards which are there, those could be typically covering just not the primary users of the general purpose financial statements. And in a normative scenario, when we look into the financial statement, the primary user of the financial statements are shareholders. So in a way, these standards are also aligned to the primary users of the financial statements. Unlike some of the standards where the stakeholders could be multitude, it could be investors, it could be employees, it could be suppliers, it could be customers, government, regulators. There could be multitude of stakeholders who could look into it, and so hence some of the standards have focus based on certain specific target audience. So SASB standards have always been historically being looked at by investors. So if companies have had investors may invest into them, they would generally, if they were to come out to the sustainability standard, they would look into the SASB standards because that was more attuned to the requirements of investors. But here again, this is more from a primary investor, users of the financial statement standpoint, in making their decision. So typically, if there is a capital outlay, if any investor or a shareholder has to invest money into the company, and then how do they actually look into it in the context of any risks and opportunities that are emanating from the in the disclosures that have been called out in these reports, which will typically have a bearing in their decision-making process. So to the extent, I think that is the primary objective of these standards. And when they do that, it obviously report material SROs, and SROs are nothing but sustainability risks and opportunities, my bad, which typically require an understanding of resources the entity relies on, the relation value chain, which means that as they get into their operations, they would know what are the resources that are available with the company and how much of dependencies are there in their value chain. And value chain typically as a concept is very relevant in any sustainability reporting, because a company has its own operations, which is, let's say if it's manufacturing, it manufactures, it has its own facility, but it also is dependent intrinsically on its supply chain and its also distribution network. So a value chain would typically in a normative way encompass all of these. It will be upstream, which is your supply chain, and downstream, which is your distribution network. So those make the value chain. And so while companies look into the risks and opportunities as far as from a sustainability lens, it is just not purely the own manufacturing or own operations that they look into, but they're expected to look into if there are any disruptions, any impact emanating from a risk of, let's say, a supply chain. I mean, let's say a company is into transportation of a crude oil, and then there are certain challenges in terms of supply chain because of government regulations, then it also has a direct bearing on the operations of the company. And so it is important, as they look into the sustainability risks and opportunities, they also look into not just their operations, but more beyond the realms of their operation into upstream and downstream. Again, when companies look into their SROs, they also need to have a direct connection with how does it impact the business in terms of cash flows, in terms of whether it's short-term, medium-term, long-term. So these are again simulations required to be prepared with the company in terms of each of the risks and opportunity, evaluate the scale, severity, likelihood. Are these risks, I mean, let's say there are weather disruptions which are happening more periodically in a particular location where they're operating. What is the likelihood of those occurring periodically given the past record, and what is the severity of such weather disruptions? Does it mean the company will be completely disrupted in transporting whatever they manufactured, or they will not be even able to manufacture for a period of time because of inclement weather? And so all of those are typically the ones that you look into, and then you bucket them into whether it has a short-term impact or a medium-term impact or a long-term impact. And include resource and relationship with link to value creation. So effectively, these are some of the things that you look into as you draft your sustainability report, where the fundamental thing that one will look into is what are the risks and opportunities that are coming from a sustainability standpoint. It also considers some of the other things. I mean, as you do this whole assessment of SRO, which is the fundamental or the start point for any of the disclosures that you do. And why do you need to do this? The reason why you do this is because at the end of the day, there could be various risks. I mean, a lot of companies would have an enterprise risk management. They have an ERM mechanism where they've identified a lot of their risks, right? Business risk, it could be operational risk, it could be a tactical risk, it could be regulatory risk, it could be anything. There could be various risks that companies identify from an ERM standpoint. But then they will always bucket their risks based on the severity and the significance. So those which are significant are the ones that they will focus on, and rest of them maybe they will evaluate and refresh as they go along. Likewise, in a sustainability reporting, what is a company, if I were to invest or you were to invest in a company which is actually publishing a sustainability report, what would it look for? It would look for to say if this company is in a pharma company or this company is into a fast-moving consumer goods company, what are the significant risks that it will have from impacting its operations from a sustainability standpoint? So effectively then that is what will be eye-catching for anyone of us to say, oh, okay, there are these top four risks from a sustainability lens standpoint, and this is what the company is perceiving as risk and impact on the operations, and how does it have what is the action plan they have to mitigate those. So I think that, and that is the reason why these sustainability risks and opportunities are prepared by management. And these are assessed to say that, okay, in a company, let's say if I continue the manufacturing company example, these are the various risks that may come in terms of pollution, emission, in terms of water, waste, could be even employees, there could be a lot of them. So you will have to bucket them in terms of then rate them to say what is more significant compared to other, and that you do also with certain enablers. As you see it, they should mandately, when I say shall, obviously they will have to mandately refer it to whether which industry that they are as far as the SASB standards are concerned. They could also consider the Climate Disclosure Standards Board. This is another framework which got, this is another regulatory body or a body which got collapsed into ISSB. So again, this was again consolidated recently, and then they folded into IFRS Foundation. And so the company, this deals with largely with water and biodiversity related disclosures. What are the risks that may come from water consumption, withdrawal, and wastage of water, biodiversity in terms of the ecological imbalances and all of those. So they give you guidance in terms of what companies need to do and disclose. And so this is again optional guidance for companies if they have water as a severity, ecological imbalance because they are actually operating in an eco-sensitive area. So these 10 could be the basis for them to evaluate and use as a threshold for identifying risks and opportunities. And they could also consider other pronouncements because there are, as I said, there is a GRI-based assessment, CSRD, there is an SEC regulation, there are quite a lot of them. There is a CDP, Carbon Disclosure Project, there are a lot of companies go for it. So there are different standard, or even there could be A lot of companies look into some of the rating agencies like MSCI, Dow Jones Index. They all have again industry specific, shall I say, risks that are emanating from from a sustainability lens standpoint. So all of this could also be used as a basis, and then identify what are the significant risks and opportunities that are relevant for the company. So I think that is the first step that companies do, and and it's a very iterative process. It is a very, shall I say, involved process, because there are different stakeholders involved. It's just not the company sitting at a particular function, be the CFO or a CEO or a company secretary who kind of does that. It is widespread, because it has different touch points. It has, let's say, production. It has supply chain. It has a distribution network. It has legal. There are quite a lot of stakeholders, internal stakeholders, HR. Human resource. So there are different stakeholders that are available internally, and likewise externally, be it the customers, be it the community around which they operate. If they are in a let's say a remote area where they are actually also looking at the community around them. So different stakeholders may give you a perspective in terms of either through surveys or interactions, and then arrive at some of these things. So this is one of the primary steps that is done, such that you are able to determine what are the sustainability related risks and obligations. And again, I did briefly allude to the fact that all of this is based on once you do that, then you evaluate how does, how do you go through this, whatever you assess, how does it go through from a process standpoint. And the process is typically relating to governance, relating to strategy, relating to risk management and metrics and targets. And we'll have we can go through it a little bit in detail. So effectively, when you look into governance, we're looking into, say, what is the governance structure in the company. A lot of companies today, when you look into it, a lot of companies, this sustainability itself is a boardroom discussion. It is an imminent topic in any boardroom conversation, audit committee conversation, where companies are being challenged and asked about what are you doing on sustainability. And so effectively, a lot of companies have created ESG governing council, reporting. It could be at a management function level, then that reports into the board of directors, or it could be a risk management committee or an audit committee. Some companies have even started creating ESG committees as a subcommittee of board of directors. So there is a fair bit of appreciation that this is a governance level discussion and requires monitoring right from the top. And so one of the requirements of this standard is to call out what is the governance mechanism or the architecture of companies which are imbibing or envisaging reporting under these standards. So again, is the governing body adequately updated or appraised of in terms of initiatives from an ESG standpoint, be it in terms of risks and opportunities that are identified, what is the basis for those, how are those being tracked to say whether these risks and opportunities have been monitored for any shall I say impacts, and if so, then what are the mitigation factors, how are those getting addressed. So all of these are things that has to be called out in terms of and a lot of this becomes a bit narrative. Some of these are qualitative, most of this is qualitative, because you're going to talk about the governance mechanism, governance structure, maybe what could be quantitative is number of meetings that the council has had, what kind of areas have been discussed. So it's a blend of qualitative and quantitative, but it is also reflecting on what as a company, from a transparency standpoint, companies are doing vis-a-vis your governance mechanism for sustainability related initiatives. Strategy is another critical one. Once you determine what are the risks and opportunities, obviously companies today, even regardless of their own shall I say initiative, because the Paris Agreement, and then we've all been as a country, we are signatory to the Paris Accord. 2070 is what I think we have as an outline from net zero commitments, where we've committed that we will as a country be net zero in terms of emissions and pollution by 2070. A lot of countries have taken it further. Advanced it to say 2050, 2040. So there are clear commitments that each of the country have done. So effectively, if we have to fall in line with the requirements of what we have as a country signed up for, it by default will be practiced or should be practiced by all companies. Otherwise, we will not be able to meet those commitments. And so again, when you do this risk assessment, you will know then you will have to have a strategy, right? If you say that, let's say you've identified water scarcity in the area you operate as a key risk from a sustainability standpoint. So companies then will need to evaluate, okay, if there is a water table depletion over a period of time, and because of which, company, if it's a heavily water consumption based company, it has a lot of water being utilized, how do they then manage? Do they then use recycled water, or are they going to shift their operations? Or if it's a third party water, if I have to purchase, then how does it operate? What is the impact on cost? Or if you have to create, treatment plants, water treatment plants, which will then make water potable and usable for many of the industrial purposes. How does it work? I mean, obviously, some of these risks that you have identified will have to crystallize into strategy, because these will have a bearing on the business sustainability and sustenance of business going forward. And so, typically, companies do arrive at strategy, which could be medium term, long term, and short term, because all of this may not be, you may not be able to, address in a short term basis, because some of this could be low hanging fruit, because they could be easy wins. Some of them will require more capital outlay, and so companies will have to budget for those. Some of this may be emerging technology which can come at a span of time, and so you will have to factor for those as and when they come up. And so it is, and then you have to build simulations, right? Because you also have to forecast for future projections of your revenue. So what you do today is based on a particular run rate of revenue and profitability in operation. But let's say this is a risk that will actually manifest itself over a period of 5 to 10 years. Then obviously you will have to also, as a company, simulate for to say that if I have a growth rate of 10% year on year, this will be my extended capacity or an expected output. And so what will be the impact of water scarcity at that point in time, and how do I simulate back to say what are the investments that are required. So there's a fair bit of scenario analysis that are required, and identifying what are these, what is the strategy for a short term, medium term, and long term. And so that is one of the disclosures that companies will have to give. Also, again, an offshoot of that is the impact from a current and anticipated financial effect of risk. So, how does it impact the operations? How does it impact your financial statements in terms of, if you are an automotive company and today companies are looking at moving from ICE vehicles to EV vehicles, and would that mean that how does it actually have an impact on your property, plant, and equipment? If you have to set up a new line to stay relevant in the business, what would have been depreciated over a longer period of time, would it require an impairment or an accelerated depreciation, more than what you would have thought in the past. So some of this could be current, and some of this could be anticipated financial effects of sustainability related risk, and so those have to be called out as well. And so that becomes a bit more relevant, and so all of this will have its own strategy bearing. How do you then mitigate those? How do you actually address those? And that is, and then it also has a bearing on the decision making. And so all of this again becomes a executive level conversation, C-suite conversation, which companies will have to be mindful of, and it's to be driven from the top. So those are things that will get disclosed. Obviously, companies, it again is a combination of qualitative and quantitative information in terms of what needs to be disclosed. And that again, is an iterative process in terms of how this gets presented. Of course, I did allude to the fact that how does it impact the financial performance, cash flow. All of those then becomes a bit of a sensitivity-based analysis. And all of this will also enable the primary users to understand what is the resilience of entity strategy to any changes. And again, resilience keeps coming up in both S1 and S2 more so, because I think it also boils down to some level of sensitivity. If there are, obviously companies have a strategy in play, companies have identified risks, but if these risks are, shall I say, not necessarily flowing the same pattern that company had anticipated. There is a disruption more than earlier than what was identified, or when expected, or there could be a new disruption that may come. What is the resilience of the company to such kind of scenario changes? And have they actually evaluated some of these in the context of scenario analysis to say that if this were to be earlier than later, or there could be another disruption that was not anticipated, how does the company react to it? So all of those becomes very relevant from a disclosure, because at the end of the day, a user of the financial statements would want to kind of invest purely based on some of these things as well. So strategy, again, like governance, becomes a very core aspect for reporting, and companies have to call out an adequate measure in terms of what is their outlook towards risks and opportunities that have been identified, and what are the threats and impact that they visualize. Yes.
Do we need to consider external factors as well?
Yeah, absolutely. Absolutely. All of this, when you look into the risks and opportunities, you don't only need to look into inwards, because obviously you will have to look into in a normative scenario. Although we don't use this concept in the sustainability standards of IFRS, there is a concept called double materiality. This is basically this standards are driven by a concept called materiality, which is normally the same as from a financial statement audit standpoint, where an omission or a misstatement of any of the facts, or which may have a bearing on the decisions of the user of financial statements. So it is still the same aspect that we go through here. But that said, when you do that, all of these risks that you are looking into has to obviously take into consideration what is impacting you as from an outward standpoint, from an exterior standpoint, in terms of how does it disrupt your business? Is a new technology emanating, or is there any risk which is emanating in terms of regulatory challenges? So all of those are evaluated in determining, but purely from a sustainability lens standpoint. So those are things that you would do. So risk management, again, it is it's again a process, right? I mean, what does the company do in terms of their own risk management disclosures? A lot of companies have a very robust ERM mechanism, enterprise risk management mechanism, but for those who they don't have, some of the companies may not necessarily have. Listed companies anyway will have, but others may not, but they are keen on publishing these voluntarily. It is again a question of trying to identify, is there a process in place from a risk management standpoint? Who's the owner of the risk register? Who does this work? What extent of, how is it integrated to the overall risk management process? Because you can't have someone doing a business risk without, and then someone else, let's say a company secretary or CFO saying, I look into sustainability in a separate line, and they can't be parallel lines. At the end of the day, they are intrinsically linked, because these are all, evaluated from a sustenance standpoint of the business. So I think that is again very important. So as companies look into some of these, they should also kind of call out how are these risk assessment practices embedded in an overall risk assessment framework of the company. And in doing so, again, they would look into typically the inputs and parameters used, whereas what is the source of data, what is the scope of operation covered, if it's a multi-location company or if it's a multi-product company, how do they typically factor for some of these from their risk assessment standpoint, what is the likelihood, magnitude and nature, because that's again a very important thing, because when you start building the risks, you would also start looking into the likelihood, because the severity, the magnitude, the scale, all of those becomes a very important quotient for someone to evaluate and say this is high risk and this is medium risk and this is low risk. So all of this becomes, again, it goes back to a framework that company may have. How do they actually institutionalize this, and how do they follow it? I think all of this becomes a bit relevant in the context of the guiding factors for companies, and these again get clearly disclosed as part of your narrative to say what is the, because then the user of the financial statement will get a good perspective in terms of the robustness of the practice and the framework that is being followed. And some of the other factors, include typically how do they monitor this risk, whether there's any change in process, you call out that as well compared to what you followed in the previous year. If there's any risk-related mitigation plans or any change in approach, because a lot of times companies do keep iterating on even the approach. I've seen companies start with some simple average in terms of arriving at a rating, because fundamentally you would require a rating. in terms of some of these severity, right? I mean, if you are to grade them, you will need ratings to say this is scale of 1 to 5, this is 5, this is 4, and people start with some simple average, and then they also move to a weighted average depending upon how they kind of look at it and assign weight. So a lot of this could also evolve over a period of time, and it depends on how mature you are. And then last but not least is the metrics and the targets. The S2 has certain requirements in terms of disclosure of metrics, the climate related metrics. If there aren't any required by standards, typically companies may also do it voluntarily. Companies may also call out their own metrics in terms of targets. What are the targets they have for, let's say, water withdrawal? And I did speak about the zero liquid discharge in terms of waste, or being water positive, and essentially then maintaining adequate levels of water balance, water table, so that they are always positive on water. So a lot of this could be facets that companies may call out in terms of targets, and not all of this need to be achieved in year one. I mean, obviously they will have it in a very staged manner, such that these are adopted and tracked and followed for implementation over a period of time. So wherever targets are there, very clearly those targets have to be called out, and what is the current status of implementation of those targets? Where are the companies in terms of those targets, and what is the action plan? There can be times when companies may set out a target for a particular year and may not meet those targets. And the fundamental part of some of these sustainability reporting is there is nothing as a compliance in terms of this, because some of these are voluntarily set targets, right? So long as companies are transparent to say why they've not been able to meet their targets and what is their plan to kind of bring it back to track and meet those targets in due course, that is good enough. I mean, at the end of the day, the reader would like to understand, are there any challenges, or has the company been pretty aggressive? Because there's also this concept called greenwashing that a lot of you would have heard. This was fundamentally to say that either they have called out something which they've not done, or misreport whatever is being done. So some of these gets very significantly penalized by different sets of people. It could be regulators, it could be investors. A lot of them have a lens around greenwashing, and that's severely called out. I mean, one of the classic case could be H&M, which is the apparel brand. It kind of got a bit docked in between. There was a news in public where they had called out about some of the sustainability in terms of recycle of cotton, or what they've achieved over a period of time, which was not necessarily the correct set of data that they had reported. And so that was called out for greenwashing, to say company was not necessarily calling out what they're doing and over-reporting or reporting something which was not appropriate. So it is important in that context to be pretty balanced, and if companies are by their own standards not able to meet the targets they've set out, it is always useful to report what are the reasons basis which this has not been met in the current period, and what is the plan that the company has to achieve those in the near future. So again, metrics and targets are things that companies will have to report as well in terms of the S1 standards. So if you look into the SROs that I was been mentioning, so effectively you do a list of risks, as I said, or opportunities, and then you assess if it's material and then disclose. So it is a bit of an iterative process in terms of saying what is it that you've identified, and again the standard says using reasonable and supportable information without undue cost or effort. So it's not like you need to go and boil the ocean in terms of some of this. It is again based on various aspects, and a lot of companies, as I said, do it in a combination of the ones that the standard itself says, looking up to SASB standards, looking into this, the water and biodiversity related framework, looking into peer sets. A lot of companies do look into what their peers are reporting. If you look into a technology company may want to look into what an Infosys is doing, or a Wipro is doing, or a Mindtree is doing, and see what are the risks that they have kind of called out, what are the material topics that they have called out, and then also evaluate whether those are relevant for the operations that the company is in. And so it can be a bunch of things that you can do, and need not necessarily mean that you would incur significant effort and time to do that. But once you identify those, then you probably grade them, and that's where the severity, magnitude, likelihood, and all of those, or nature, becomes a bit relevant for you to assess and rate them accordingly. And once you do that, you go to disclose those, as we said. Yeah. So this kind of articulates what I said in terms of going to the SASB standards. Looking into same industries, what are the peers doing, or the similar geography, and then typically when you do the disclosures, then you say that you actually, what are the things that you've considered, is the SASB standards or any other metrics of the GRI, ESRS is the CSRD standards. Is there anything that are coming out of that, so long as they don't conflict. So once you do that, then you could also consider the CDSB framework for the water, biodiversity, and any other recent concerns. So it's a bit of a, I would say, look around for similar sets of regulatory requirements, similar sets of industries, peers, and then arrive at something which is more customized for the company in itself. And then value chain, I did briefly allude to the value chain, and value chain is a very, very important concept as far as sustainability is concerned, because the company on its own, when you go back to the earlier slide, when you look into this, when you're identifying the sustainability risks and opportunities, it's just not merely from your own operations standpoint, as I said earlier. So that's where value chain becomes an extremely important part of the overall ecosystem of determination of risks and obligations and opportunities, and also reporting therefrom. And this is really, and it is again, I would say, a judgment-oriented thing, because if you were to take an automotive company, and if you're an OEM, auto OEM will have different tier 1, tier 2 suppliers and thereafter. Right? And all of these are value chain for you, because there is a tier 2 supplier who supplies to tier 1 then supplies to to the OEM. There could be risks and opportunities relating to sustainability cutting across different strata of your value chain itself. And so where do you stop? Do I stop at tier 1, or do I need to go to tier 2, or do I need to go to tier 3, or is there a subcontractor? Where do I draw the line as a company when I actually start evaluating which are the aspects of sustainability risks and opportunities that are relevant for a company? And so that is where it becomes very relevant and important and judgmental to say, these are my material suppliers, and so if anything goes wrong with these supplier, including their tier 1 supplier, then I will have a bearing on my operation. So companies will have to evaluate on merit and carry out significant judgment in terms of figuring out whether it is, because someone can come and argue that, look, I am in a business where I'm in an e-commerce business, I'm actually selling some item, I'm a marketplace which is facilitating a buyer and seller, and the product that is sold here through my platform has some minerals which are used, and that could be mined from a particular place where child labor could be used, or forced labor could be used. But if you were to then start evaluating whether is that material from a marketplace standpoint, because what you are actually selling is a product, facilitating a product to be bought and sold. And so while forced labor or child labor could be a very significant reputation issue if it comes to know, and a sustainability issue, one will have to evaluate whether is it the magnitude and the severity is such that does it warrant you to then consider that as a sustainability related risk for you. So each of this has to be looked into from a lens of your operations or the company that you are advising, in terms of saying what is material for your operations as a company, and hence then table those as well, and then evaluate what are the targets, what is the strategy, what are the metrics that I want to monitor. Are there the key? These are the key metrics, which could be to say that water consumption for the year, water withdrawal for the year. It could be water which is recycled back in terms of whatever procedures that they've done to get the water recycled. So each of these metrics could be then different. So again, this becomes a very core for one, and to that extent, value chain becomes very relevant. And value chain, as I said, could be upstream or downstream. Upstream is typically the supplier part of it, downstream is the distributors, customers part of it, and so both of this have to be evaluated in equal measure. as you probably can identify the sustainable risks and opportunities. And this comes from typically the right-hand side, the impact of value chain. It's evaluated, and this again, I'm sure if you've looked into integrated reports, companies publish, let's say Tata Steel or Wipro, Infosys, there are many who publish integrated reports. And if you look into it, they would have actually bucketed all the sustainability aspects in these 6 lenses. I mean, in terms of financial capital, manufacturing capital, intellectual capital, human social relationship, 5 of them, sorry. And typically these are the buckets in which companies will call out to say, what are they doing, from a manufacturing setup, what is it that they have done from an advancement, efficiency, sustainability. Similarly, intellectual would be R&D and all of those. So again, value chain is also portrayed in the context of all these capitals to say that as you start looking into each of this and then comparing with what value chain does for you, if there is, let's say, if you're looking into social and relationship, are you actually able to kind of, create in your value chain, let's say your company is working in a very, for want of a better word, a godforsaken place, very remote area, but then it has a lot of community to develop around it. So the ecological system of creating a value system of various suppliers around it, and then giving them that social, shall I say, uplift could be, evaluated from value chain. You could evaluate it from a social standpoint to say how are you actually improving their social status in terms of given the opportunities that you are providing to them as a company in building their economic substance with respect to their operations. So all of this have to be evaluated in these contexts. Financial could be even advances, because a lot of tier 1 companies will get advances from OEMs, in terms of running their business and then taken care of for a period of time. So each of this has to be looked into in that context, and so value chain becomes a very important thing. But I must also tell you, value chain is also very difficult. Because one is you can identify the risk, which is a lot more easier, but once you do that, and if you have to collate some of the data relating to them, then it also becomes a bit difficult. Even in context of the current BRSR, there have been discussions, companies, public interest entities, listed companies, which are top 250 by market cap as on date, are expected to report on their value chain on certain BRSR core requirements, which is to do with energy, emission, to do with waste, water. Some of the core indicators have to be called out, and companies will have to report along with their own data set. Well, of course, there is a bit of a rethink by SEBI, and then they've come up with another paper for ease of doing business, and then that has been subject to public comments, but that's not still found its way in terms of finality. There was some simplification attempted in that. So we're still awaiting any changes around it. But as it stands today, it requires companies to call out along with their own data set on some of the BRSR core requirements, data set of top 75% of their purchase and sales. They'll have to look into it, and those customers and vendors, they will have to provide the same set of information. So value chain is itself a bit of a challenge, because not all of them will be the same level of maturity as a company is in terms of keeping data, maintaining data, and then collating and providing the data as well. Some of the other principles which I very broadly alluded to in terms of when you draw a comparison with AS1, Accounting Standard 1 or Ind AS 1, typically some of these are relevant even from a sustainability reporting standpoint. Materiality, fair presentation, connected information, and reporting entity and boundary. Materiality, of course, it takes the same shape and color as that of materiality. What is material for financial statement standpoint, where any omission or misstating or obscuring of information could reasonably have an impact on the decision making of the user of the financial statements. And so that's not any different here, and so to that extent that remains constant. Fair presentation, obviously, just as we have the fair presentation from an accounting framework standpoint, it is similar in terms of providing the relevant disclosures, and then a faithful representation of what is the principle set out in the standard. And so to the extent it has to be kind of fit for purpose. Reporting boundary again, and the entity, Typically, companies may, if they are, it has to be coterminous with the financial statement audit. I mean, financial statements presented. So, if the let's say companies are reporting for a particular entity, then they should look into it from that particular entity standpoint and give the information, and also for the same period. Let's say if it's April to March, then they should actually have the same set of data being presented for a period of April to March. Unless if they are going to do it for a period lesser or more than the financial year, they will have to call out the reasons why they are doing it in such fashion. Connected information, I think we briefly spoke about earlier in terms of the interconnection between financial statement related information and sustainability information within the various data sets that are being provided or disclosed from a sustainability standpoint. How are they intrinsically linked? So all of those becomes a bit relevant, and that has to come through in the context of and some of this is a narrative, right? I mean, if you see a lot of these reports, they are, they call out, although they have quantitative information, but it's also an articulation of what companies have done as initiatives and, the governance, the structure, and all of those, their strategy, all they have. So all of this then has to be connected, like a connected dot kind of thing in terms of what is being reported in one portion of the report, another portion of the report. But these are some of the principles, the guiding principles that companies have to keep in mind when they prepare these reports. Again, in terms of the location of disclosures, I mean, there is no specific requirement in terms of if you would note in an annual report, when companies do prepare annual reports, they have these mandatory sections, right? One is the financial statements in itself. They have the board of directors report. If it's a private company, if it's a public company, they have the MD&A, and then there are other statutory reporting like a BRSR. So there are different reports that come in, which are mandatory based on law, be it SEBI or be it in respect of Companies Act. So here I think there is nothing which is mandated in terms of where it has to be placed, but typically you would expect these to be part of management commentary section, which is like a MD&A, or you could create one section along with that as part of the annual report just before. And if you would see a lot of companies currently do it that way. They would have these come out, if it's an integrated report, discussions on all the capitals before they start with the regulatory requirements in terms of the board of directors report, MD&A, and then follow suit with corporate governance reports and so on and so forth. So location is again optional. There are if and when countries adopt these, have a specific mandate in terms of where this needs to be disclosed, companies will have to follow those. Failing which, they could do it, and you typically would expect them to do it as part of the management commentary section. Timing of the reporting, I did briefly mention, it's at the same time as the financial statements, must cover the same period. But I think in the first stage, there are some transitional provisions available in terms of saying you could actually delay it beyond the time by which you would report on the financial statements. You would have a leeway of, let's say, 1 year, 9 months to 1 year, within which you'll have to do, but that's only from a transitional first year standpoint. But thereafter, it has to be coterminous with from a reporting standpoint. Ideally, a lot of companies today even do that because there is no specific mandate in India where they do a reporting under the GRI framework. You would see a lot of companies upload their reports, sustainability reports, much later than getting there. If it's a listed company which has a mandate to complete their audits and publish to SEBI by end of May, you would see a lot of companies still not doing their sustainability reports by then. They would do it later, then put it up in their website before their annual accounts get circulated. So there's no hard and fast rule today in terms of when it has to be done. Of course, companies do bear in mind the timeliness of any reporting, because what's going to be issued 1 year down the line has got no relevance beyond a point. So I think to the extent that is still relatable in terms of the requirements of S1. Comparative information, again, the previous year numbers are disclosed. Wherever there are narratives required, that is also called out, which is significant from a prior year standpoint. Again, there is a transition provision available in terms of saying the first year you don't need to give the comparative, and if you're if it's for climate related risk and other data sets that are there, you don't need to kind of call it, because if you adopt S2 along with it, you don't need to give the comparative. So there are some transitional provisions around that. And then there's a statement of compliance. I mean, if you would have noticed, many of the companies, when they issue an integrated report today or a GRI report, they'll have to also, and I mean, even in India, if you were to draw a parallel, companies will have to call out in the base of preparation that these are explicitly in compliance with the requirements of Ind AS. And same is the case even in case of the sustainability standards. Companies will have to report that they are in explicit compliance with the requirements of standards from a disclosure standpoint. There's nothing, I would say, there is nothing penalizing them if they are not strictly in line with the standards, unless until if it is adopted by a local, by a country regulation, and then they have some guidelines for non-compliance, strict non-compliance with the standards. But then companies, ideally, I would think, will have to then call out why are they not in compliance, what are the things that they are not in compliance, and why do they believe it's not in compliance, and so they probably have to call it out. So if you look into the GRI standards, the Global Reporting Initiative that I mentioned, which is most widely used standards, they had come up with these standards. They refreshed their standards a couple of years back, and they had two options called out. One is with reference to GRI standards and in accordance with GRI standards. So in accordance with GRI standards, pretty much you follow the entire GRI standards in that sense. If it's with reference to, then you're not necessarily doing all the things that ought to be done under the standard in terms of disclosures and following the standard, which is still okay. I mean, it's just that then you'll have to have a glide path to say by what is the future course in terms of how do you want to move from with reference to in accordance with. So each of the standards have these as some of the basis for readers to appreciate whether this is in line or it's not in line. And so S1 is not an exemption in this regard, exception in this regard. It also expects companies to call out that they are in explicit compliance. Just like any other standard setter, I think they've also taken cognizance of the fact that some of the information could be not permissible under the local law, or it could be very commercially sensitive for some of the companies to kind of disclose it because it could provide a competitive advantage. And so those then still can be called out and mention that some of these are not disclosed because of ABC reason, which is either because the local law says not permitted to do that, or there is a competitive advantage that you may give away by kind of disclosing some of those. And so to that extent, companies can call it out to say that such information is not being disclosed. And this is again pretty constant for some of the other international reporting framework like GRI, where even though you may be in accordance with, but subject to certain exemptions like these, where it clearly says if it's not required by law, or it's extremely impracticable to get the information, or it is so customer sensitive or competitive information that you give away, advantage that you give away, and so you don't. So there are again reasons basis which you can still call out and say that you are not necessarily reporting on some of those information. Okay. Judgments and estimates and uncertainty. Again, judgments, estimates, uncertainties, errors. Again, if you were to draw a parallel to what we do from a financial statement standpoint, you do have judgments more so for any financial statements that are prepared, right? I mean, we do have judgments and estimates, be it in terms of allowance for of doubtful debts, or provision for inventory or warranty, and likewise sustainability standards are not, or the measure of sustainability standards are not necessarily devoid of any judgments and estimates. Companies do have judgments in terms of when they report on certain information, they may not necessarily have all the information. Let's say some of the examples could be, let's say if companies are operating through multiple retail outlets, and then they don't necessarily, they have to track and provide information on energy consumption, how much of this is out of renewable, how much is out of non-renewable, and so if they're not necessarily having information for various outlets that they operate, maybe they will, some companies to start with, as they evolve their practices of capturing data, could use judgment in terms of saying, for this floor index of floor space that I operate, this is my electricity bill, and if let's say you have for one or two outlets, which is very clearly evidenceable, then companies may look at it to say that I built this up for the entire, extrapolated for the entire population of outlets that I run, having regard to the floor space that they occupy, and so per square feet, if this is the rate, and then you multiply it across all square feet of outlets that are occupied, and arrive at it. That could be a judgment. I mean, it's a right or wrong is another thing, but at least if companies wish to go down to provide some data in terms of some of the energy consumption and all of those, then companies may want to look at it, depending upon how accurate or how sensible it is from a data standpoint. So there could be a lot of judgments that could be involved in terms of providing certain information, even in terms of assessing risk, right? I mean, if you were to look at the risk that some of the risks that I spoke of in terms of saying companies which are in automotive space who would like to move from ICE to EV at some point in time because it's a transition risk that they will have, and so they will have to be mindful of that. There could be a judgment involved in terms of when does it impact them. From their own scenario building and simulation, they may figure out that it may impact them in 5 years' time for a particular reason. There could be a judgment or an estimate based on which they would do. This is the run rate of EV uptick on a year-on-year basis, and so expectedly, ICE will be dispensed with EV by a particular year, and so this is probably the horizon basis which. This is the horizon basis which there's a sunset of ICE and then there is an augmentation of EV vehicles. So that's again a judgment, right? I mean, that could be based on industry data, it could be based on some other benchmarking that they might have done, or the technology improvements over a period of time, or the customer preferences. So it could be a survey, whatever it is. So there are a lot of judgments that may be involved even in identifying risks and opportunities and the severity of those also. So companies need to kind of be mindful of those and disclose those judgments, because the reader has the financial statements also would, or the sustainability report in this instance, would like to appreciate what is the underlying basis which some of these have been reported. So that is one area where, just like in financial statements preparation, becomes a bit paramount from a disclosure standpoint. Okay. And measurement and outcome uncertainties. If there are any uncertainties that have a significant effect on sustainability reporting, typically to say there could be uncertainties in terms of predicting some of the outcomes in terms of whatever estimates that company may make. Then you would also put out, obviously companies would use a best estimate of some of these in arriving at an assessment. But companies need to disclose some of the uncertainties, because of which there could be an underlying impact in terms of which way the risks may go, or how does it pan out. So, if you have some of those, then those need to be disclosed. Retrospective adjustments, because you've got some new information, which is not very uncommon, even in a financial statement standpoint, right? Because there are a lot of judgments and estimates which will have a retrospective adjustment, because you would have better information subsequently. And so, would it mean then you need to go back and disclose some of this as and when you get new information? But of course, it doesn't need to restate any of this, because it's not an error. It's only a coming to effect of new facts, which makes you kind of reassess and then call out some of these as you go along. So those kind of things need to be also brought out. Errors, of course, will require restatement. It is not any different from the IAS 8 or Ind AS 8 in our context in terms of how do errors get accounted. Typically, there is a restatement, and then you would go back and restate your earlier period and not adjust like our AS5 here, where we will adjust any prior period adjustment in the current year P&L. Likewise, even for sustainability related financial disclosures, you would go back, and if there are errors noticed, it will go by. You will have to go back. Companies will have to go back and reset the comparative accordingly and call out as restated, and then provide the adequate disclosures to say what is the error and how is it being. Why is it being restated? So these, again, some of these are pretty known topics, I would say, but still relevant from an expense standpoint. As I said, this is effective for annual reporting periods beginning on or after 1st of January. Early adoption, but of course early adoption is more academic now. But again, it boils down to each country. I think a lot of countries have picked it up. Singapore, for example, Canada, many other IFRS-oriented countries have started embracing these standards and bringing in law to kind of bring out to say that these standards could be used. or should be used in that sense. We will have to see from an Indian context how this kind of pans out. Currently, our only reporting framework is for listed companies, which is BRSR, where that's more a reporting requirement. And so, we will have to wait and watch how this kind of translates into specific standards from an Indian context. But nothing stops us from, companies from looking at it, because there are companies which do report on sustainability and they do use international framework for these. I'll pause here. For S1, that brings us to the end of S1. Is there any specific questions or any reflections, anything that you would like to know? Happy to take, otherwise we can jump into S2 as well.
If India, we want to follow this IFRS S1, do we need to follow same, or India maybe, as like India is like conversion to India is like that?
We will have to evaluate, because I think this will all be a very evolved process, because there will be a lot of discussion across just not the standard setters, but even various stakeholders, including regulators and others. I'm assuming we will certainly want to take a closer look at these standards and not just adopt them as it is, because maybe what is more relevant for the rest of the globe may not be relevant, because we are a developing country as well. And so what do we want to do is, I think, more fundamentally driven by how us as standards, the Institute as standards, a body which kind of looks into some of these things, along with the other regulatory bodies, will have to evaluate. That's how I think it will go. It may not be a direct convergence or a adoption. But we don't know. That is, I don't know. I haven't had any insights in terms of which way this is heading. But I guess that will be the case.
But as of now, it's not mandatory in India.
That's right. Because it's not mandatory anywhere else. As I said, we don't necessarily adopt IFRS. It has to be then promulgated through any law. I don't know whether it will come through the Ministry of Companies Affairs, Corporate Affairs, through the Companies Act. What will be the basis? Because if you see today, technically auditing standards and accounting standards in India are all driven by all the institute had set it up, but I think after a point in Companies Act took it up, and it is it's kind of adopted through those, right, through Companies Act. So I'm assuming some of this may also, because this is all pretty relevant from an auditing standpoint from all of us. If companies will want sustained reports to be also assured at some point in time. And so, which means then it may get funneled through the Companies Act. I'm pretty much not sure on which way it is heading.
Here, applicability you mentioned like 1st January 2024, right? That means applicable only for the MNCs, right?
No, anyone who wants to follow. Because it does not distinguish between public interest entities or private companies. Companies who wish to publish their sustainability report can use this as a basis. There are many other standards as in frameworks which are also available, but if companies want to use, it again depends on wider acceptability, isn't it? Because if it is IFRS is a known language from an accounting standpoint across the globe, so a lot of countries may want to use that. But as I said, until all of this came into picture, most of the companies even today are following global reporting initiative, GRI, which is the standards basis which all of those is reported. But companies will start moving away because companies will start moving away because all the European companies which are listed and large entities, they have a threshold based on, as I said, assets, net assets, revenue and employees. All of these are now moving to European sustainability reporting standards. So the CSRD becomes the norm. So most companies will not want to do double reporting. If they were under GRI in the past, now they will say, I don't want to do GRI. I will actually do only CSRD, because CSRD has close to more than 1,000 disclosure requirements. So companies have to disclose on various aspects like water, biodiversity, pollution, then social, own workforce, extended workforce, value chain, workforce and value chain, then communities, governance. So there are roughly around 10 to 11 standards there. And so they have to report, if you identify some of these as material topic, they have to report under all of this. They have roughly around 1,100, 1,200 disclosures or more than that. And I forget the count, but certainly more than 1,000. So those disclosures have to be called out. So they're very prescriptive again. So if they do that, then they will not want to go into another standard and then report, because there's so much of cost and time. So people don't have that luxury at this point. So So slowly but steadily, you see Europe moving into that direction. Rest of the world may be looking at IFRS as a substitute for GRI if it's being regulated by the local law. Otherwise, companies are free to choose what they want. Sure. Okay. So, S2 is largely to do with climate-related disclosures. At the end of the day, it talks largely about climate risks and opportunities again in terms of what is relevant to the primary user of the general purpose financial statements for them to decide on their capital outlay, whether they want to invest. So climate risk is an important aspect that and the related disclosures that companies do generally have to report, because you see obviously with this Paris Agreement and 2017 Indian context and many other countries taking a pledge to be net zero by an earlier date, you would see that there is a fair bit of shall I say focus on climate related initiatives. A lot of companies do call out climate related risks, climate related initiatives, the emissions of emissions that are coming out of their operations, extended operations, and what are they doing to reduce those. So there are a lot of focus on climate related initiatives of companies, and it also has its own benefits, because a lot of investors today, globally private equity investors and others, are willing to provide a sustainability based finance, which means if companies go out and say that, look, I will reduce my energy emission from X to Y, or I will actually up my the source of energy from non-renewable to renewable, and I move up to 100%, then maybe the investor may say, I will give you a loan at a lesser interest rate. There are banks which have stopped across the globe. You would see that a lot of banks have stopped funding fossil fuel based entities. It could be including coal mines, natural mines, all of those. So because if you are in a finance function, you want to demonstrate ESG, then you will have to be looking at it from this context, because your own consumption in a bank is a service company, they're not a manufacturing company. At best it will be electricity in branches and all of those, right? And travel, if at all, if they have to travel from one location to another and all of those. So that's not going to contribute much in their overall, if they want to contribute more. So it can only happen through capital outlay, evaluating their projects from a sustainability lens and ensuring that they are actually contributing to society by only funding those which are sustainable in nature, and not necessarily funding non-sustainable or non-renewable sources and all of those. So, so climate has, and even if you see in Indian context, RBI has come up with clear requirements for regulated entities in terms of what needs to be disclosed from a climate risk standpoint, because they are also part of a global arrangement where based on which RBI is also signatory, and companies are expected to, or the funding agencies are required to talk about or disclose their climate risk related risks and what have they done around that. So there is a fair bit of focus across the board on climate risks and opportunities, and so the standard pretty much drives or governs how companies need to kind of report on all of those. So again, there is a bit of overlap in terms of some of the, because IFRS 1 is more a general standard, right? It kind of sets out the preamble in terms of what are the things that you need to look into. So IFRS 2 also has references to IFRS 1 in terms of some of the things like fair presentation, materiality, relevance, all of those. So obviously a company will prepare using IFRS 2 the financial statements in accordance with with IFRS standards or other GAAP as well. It could also apply this along with that. So it's not hard and fast that if a company is only following IFRS framework, then they will have to do an S1 and S2. It could be for any other GAAP as well. And then it typically talks about 2 or 3 things, right? I mean, it talks about physical risk, transition risk, and climate-related opportunities. Physical risk is nothing but risk which has, let's say, if there is already a flooding in an operation in which you are operating out, in a place that you are operating out of, or it could be water scarcity, which is actually already happening. That is a physical risk. That's a risk which is actually a risk which is emanating now. Whereas a transitional risk is, if you were to, what is the risk of moving to a lower carbon economy, which is the example I gave in terms of moving from ICE to EV as a segment. What is the risk that it entails? It could include shutting down operations, dispensing with labor, change of technology, so supply chain may get disturbed because you may not necessarily need those people whom you are working with from a supply chain on engine, and could be many other aspects. So transition risk is more to do with what will happen in the context of moving to a lower carbon economy. Physical risk is what is actually emanating now by virtue of you operating there. It could be water, it could be floods impacting you, seasonal weather which has caused disruption to business. So those are physical risks. So and then of course climate related opportunities. What are the opportunities that you're looking at from a climate related standpoint? Be it in terms of from a future standpoint. So these are some of the things that will get disclosed mandatorily under the S2, and this again will a lot of this again, as I said, these standards are drawing inference from TCFD, which has pretty much been the hallmark of reporting from a climate risk and matrices standpoint. So it because that's collapsed into the IFRS foundation. Now effectively you would see some of those getting reflected in the S2 standard as well. Although I must tell you, companies do still follow TCFD as a reporting requirement. A lot of companies do use TCFD as a basis to report on their climate-related initiatives, risk, and all of those. And then they also get it audited. They get it assured by accountants in terms of what are things that they do there. Okay. And in terms of identifying the climate-related risk and opportunity, obviously again it goes back to the point that we mentioned. Without undue cost or effort to identify some of this, have reliability of information, those should be supportable and evidenceable in respect to what's the basis. So obviously again the industry-based guidance, which comes from the SASB standards as well, because SASB standards again, as I said, is for 77 industries and all. And so if I'm sure one of the industries will fit into the ones that you are actually operating out of, and so that is another basis to kind of look into to say what are the climate related risks that may come out of that. And so these are some of the things that one has to bear in mind, which is not dramatically different from what we saw in S1. Some of the similar principles there too. Again, it goes back to the same 4 pillars here as well. But of course with a climate lens, I would say, because what can happen, the reason why it could be different is sustainability is a little more, climate risk is a subset of sustainability related risk and opportunity, right? Sustainability could include just not climate, it could include waste, it could include water, it could include employees, workforce, there could be, or it could be even governance in terms of ethics, code of conduct, operations, ease of doing business, what are the ways of doing business rather. So it is a lot more pervasive. I would say it's a lot more at a higher level, and S2 is more a subset of S1 in that sense. But regardless, it will still have to be evaluated in the 4 pillars, which is governance, strategy, risk management, and metrics and targets. Similar to what we discussed in S1, governance around climate risks, opportunities, tracking those risks, reporting up to the board or the highest level, what's the level of involvement at the management level, and how do they actually monitor some of these. So, typically as any controls in place in terms of evaluating their implementation. So all of those gets kicked in from a governance standpoint. Strategy, of course, needless to mention, it needs to address clearly the following that are below here. Typically to say what are the qualitative, quantitative information on the current and anticipated financial effects. So each of this, how does it have an impact on the, if let's say there is a flood which could be envisaged, and then so how does it impact the financial effects of those from a climate risk standpoint, and then again how does the entity plan to achieve their targets? Because of all this climate risk, in spite of that, how do they actually go about achieving their targets? What are the assumptions used from a transition standpoint? If there is going to be a BCP or a backup business continuity plan in respect of some of this, then what do they do? And again, scenario analysis, because this again goes back to climate resilience to say if any disruptions, any plan A, if not plan A is not working, how does plan B look? and so that's where the scenario analysis kicks in, and then you need to call it out in terms of how do companies plan for scenario analysis and what are the sensitivities that they have kind of carried out. All of this, of course, has to be should be borne in mind in the context of the undue cost and efforts that may be required. And also, one of the things that we need to bear in mind is some of these are very technical. It's not like some of the simulations that we do, it's not like an accountant will be able to do. Because a lot of this has got a lot of science behind it in terms of disruption, water, waste, or even if you look into pollution, emission, if you have to convert yourself into renewable. So there are a lot of, and it could also involve manufacturing related changes, right? Operational efficiency, or even changing the ways of operating, developing new technology, or imbibing new technology, or even changing a supplier for a matter. Because you're going to get something which is a lot more energy efficient or emission efficient, in terms of what you get. So a lot of this is just not a play of math where we as accountants will be able to kind of control. So companies will have to, rationalize this and get this done through in a logical manner with the different stakeholders. Largely could be internal, because you will have a production head, you will have a supply head, procurement head, you will have a lot of these people, CEO, there are different sets of people with different competencies and background who will have to provide those right inputs to build scenarios, build the impact of these on financial statements, all of those. So it's a pretty combined effort and intense effort in terms of strategy in itself and their implementation therefrom. Risk management again follows the same pattern in terms of identification of risk, the overall overlap between that and the company-wide risk assessment, monitoring those risks, evaluating, refreshing those risks for a period of time, and disclosing the process that is in place. Metrics and targets, again, this standard has certain specific standards in place, 7 cross-industry metrics which we'll look at as we go along. There are also industry-specific metrics, and then what are the other aspects that they've identified. So S2 has certain call-outs in terms of what needs to be called out from a metric standpoint, and those needs to be kind of adhered to by the companies. And then if you see the cross-industry metrics, typically things like GHG emission, this is greenhouse gas emissions, what are the kind of emissions that are there. It could again boil down to scope 1, scope 2, scope 3. It's a concept which I don't know whether all of you are aware of. Typically, to say if there are emissions happening, you categorize them into the 3 different scopes. What is under your control and actually happens in your premises where you control the operations, that is typically scope 1. So if, let's say, a diesel generator is run, a generator is run on diesel which companies purchase, the emission that is coming out of that is typically scope 1, because that's basically controlled by the company. The use of diesel in a generator is controlled by the company in terms of what's the quantum they want to use. A scope 2 will typically be an indirect emission. Let's say a company gets electricity supplied from Tangentco, and then Tangentco burns coal to generate electricity. So that is scope 2, because there is emission that is coming indirectly, but you are using as a company using the electricity which is generated out of coal, burning of coal, and so that is quantified as a scope 2. Scope 3 could be anything in your value chain. I mentioned upstream and downstream. It could be even let's say employees traveling on business visits. So if you see, a lot of companies now have become very conscious about business class travels, because typically a business class will occupy 2 seats compared to an economy, and so a lot of aircrafts, if you see when they issue tickets, they will also call out the quantum of emission that is being burnt by a ticket holder. And so a lot of companies are creating their ESG dashboards, calling out at an employee level what is the footprint of carbon that is being emitted in that regard. So there's a lot of awareness that is done. So scope 3 could be in the value chain, it could be transport, it could be even procurement, supply, distribution. So if you are procuring material for manufacture and there is a transport that happens from the customer, from the suppliers end to your end, the emission that is coming out of the transportation, that is also part of scope 3. So scope 3 is a little more wider in ambit, and that is more difficult to either control as well as to collect data, because there's fair bit of, there are 15 data indicators from scope 3 standpoint that one has to look into. and then that data set is a bit of a challenge as well. So scope 1 is largely at least under your control, because you would know if it's diesel, in my example, you would know when to operate, or you can find an alternate source in terms of renewables, and so the diesel generator is not necessarily operated to that extent. And again, scope 2 could also be controlled, because you may want to move away from electricity from tangent code to power purchase agreements on windmill and solar, such that you are able to kind of negate the use of energy from non-renewable sources or fossil fuels. So these are GHG emissions. So they are disclosures related to that. Climate-related transition risk, which I spoke about in terms of the typical example of ICE to EV. Physical risk could be, let's say, flooding of area, or in a low-lying area, if you're operating on a low-lying area where there can be a water stagnation, so that could create a physical risk of operation there. So what is the probability of the risk, and how are you actually as a company mitigating that risk? Opportunities could be at an overall level. What are the climate-related opportunities that you can actually look forward to in terms of moving to cleaner technology, cleaner environmental-based initiatives, all of those. Capital deployment again goes down to what, based on all the risks that you've identified, what is the capital outlay? I mean, how do you look yourself up in terms of the allocation of capital to some of these initiatives, and what do you intend to do from a climate risk mitigation standpoint? Internal carbon pricing. A lot of companies have also started doing internal carbon pricing to say, typically to say, if I'm moving goods from one location to another location for captive consumption, then there is also carbon pricing. I charge for whatever carbon that is emitted, and then I actually collect it from them, and so then companies try and look into it from an overall carbon pricing mechanism to say who's more efficient and who's less efficient in that sense. And remuneration, again, that's again a big thing that has caught on in terms of the C-suite, where a lot of companies, multinational companies and others, have started linking performances. Earlier, we've all been used to performance-based incentive, which could be based on individual performance of the company, or performance of the share price. It could be a lot of this linked to some of these things, but now it's companies are linking performance incentives to ESG initiatives. Our companies, as if let's say as a C-suite, it be a CEO, CFO, or a CTO, or a chief production officer, whatever, head of plant. What are the ESG related initiatives that have caused reduction in certain sustainability matrices, improvement in sustainability matrices? Those are then put as an incentive parameter, and so a lot of companies have started looking at it more closely and saying, if I don't bring in operational efficiency, or my emissions are at this level, then I'm not going to get a bonus. I mean, the weightage of bonus is reduced because of that. So that is another thing that has actually started coming up as well. So that is another aspect, and these are the areas where companies are expected to disclose the 7 cross-industry matrices, I would say. We spoke about scope 1, scope 2, scope 3. I mean, on GHG disclosure, these are again, companies have started doing a fair bit of work in terms of all of this. Again, as I said, the hallmark is without undue effort and cost for all of those. And so, but of course, I will tell you, scope 3 is a very difficult one to go back and get. So companies do something called as a life cycle assessment. A lot of companies take a particular product of theirs and then knock it down to say, for one product, one unit of a particular product that I manufacture, what is the overall carbon emission end to end? So it could be something called as a cradle to grave or cradle to gate. It could be a lot of, there are different methods in which companies do. When I say cradle, obviously right from the sourcing standpoint till gate, as it indicates, as it leaves the factory. Some of them do cradle to grave, because then how does it get recycled? If you actually are a tire manufacturer and you want to look into to say what's the emission that is coming out of my usage of tire right from start of procurement to retreading the tire, because tires may get reused, retreaded, and then finally could be used for anything. It could be rolled over and played, or it could be even done differently, teared down and used for different purposes, or burnt, as we would see in bogie. So there are a lot of things. So companies may want to track and say what's the in the life cycle of a tire, what is the overall emission that happens. So a lot of companies have started doing that, and for that you need scope 3 data, because you need to then go through the entire value chain right from beginning to the end. And so that's another area that a lot of companies are focusing on, because that also gives them some level of competitive advantage, because once they do it at a individual product level, a lot of companies are looking at something called as green labeling. So they want to, you would see that some of the products are packaged and say our product is actually green product because we've actually looked into it, the life cycle, and we know that this is the emission and we've tried to bring it down. And so there is some element of marketing that goes in based on what they are able to do. So those concepts are also picking up. So a lot of companies anyway are wanting to capture this data, and if you're going to anyway look into reporting and use S2, then these have to be disclosed. And the one of the things that companies also need to be mindful of is the measurement method, which is either an equity share method or a control approach. As in this case with any financial statements, if you have a significant influence or a joint venture, you would have an equity pickup done. I mean, you only pick up the results of the profits or share of profits or losses of those entities. And likewise, if you are actually, if the reporting boundary is a consolidated disclosure of the group, then it could follow the same way. So if the company has a 20% stake in another company, they could pick up 20% of those information when they do a consolidated reporting, and likewise, if it is a controls approach, it could be both financial control or operational control. Companies will have to evaluate. Generally, this is based on a GHG protocol, which is there, which is an accounting guide, which is the basis for which it's available in public domain. You can Google and see, and there is this website on GHG which will actually give you a detailed document, so a good speaking document on how is GHG accounting done in terms of inventorizing the scope 1, scope 2, scope 3. So there again, while it's not necessarily in sync today with the IFRS 10 or Ind AS 110 from a consolidation approach, but it will get there. I think they are working through to see how coterminous it can be with the accounting itself. So controls approach could be either financial control, which as in the case we know if it's a subsidiary, you have 100% or 80%. You won't necessarily do 80% there. You could, depending upon what is the level of operational control, because even if as a company has 80% in a subsidiary, it will still have operational control. While you may have financial control of 80%, it may still have an operational control because it will direct the usage of resources and for the purposes for which. So then the question that comes is, should I do 80% or just 200%? So that again becomes a judgment, and more likely than not, you will end up consolidating the entire 100% of their data into when you do the sustainability report at a consolidated level. And there could also be the controls, operational control approach could be where the company may not have a financial control. This can happen in cases like your, you have a lot of these oil and gas companies where they have an unincorporated joint venture. There would be a production sharing contract and a joint operating agreement where 2 or 3 parties may come together and operate an oil well. They will drill through the oil well, and then there will be one of the joint venture parties will be the one who will actually do the operation, and rest of them will typically get a share and all of those. So while none of them control, but then the operating control will be lying with the operator. So one of the 3 will be, or 4 will be designated as an operator in the oil well, and then the entire contracting for oil rigs, drilling the oil wells or exploration, all of those will be done by the operator. And so in those kind of scenarios, if an operator is actually preparing a sustainability report, then they may actually consider the oil well, wherein they may not have a financial control but operation control from a consolidation standpoint. So it's pretty nuanced, but since we know consolidation from an accounting standpoint, I am assuming it's not very different, but although there are some differences, but I think that is in the works in terms of aligning with the accounting part of it. So which is what I actually mentioned about the equity method and the control method. Some of the other disclosures that companies need to do when they actually set out their net zero targets. they'll have to call out part of the entity the target applies to, because if it is, if they are a diversified business and then they are actually setting out some targets in terms of saying, for this business I will actually become net zero by a particular time, then you need to call it out. Period again, which target applies, by when, let's say a lot of companies call it out to say 2040, 2050, they don't necessarily go up to 2070, some of them may call out. Again, these targets are largely, a lot of companies today are doing a scope 1, scope 2 target. They're not necessarily doing a scope 3 also, because scope 3 is the most difficult one, but at the same time it's also difficult to estimate. And so I would say in a scale of balance, close to around 70% of the overall GHG emission will be coming from your scope 3. Scope 1 and scope 2 will make up the rest of them. So a lot of companies have also given targets for scope 1 and scope 2, and not necessarily net zero targets for those, and not necessarily for scope 3. But some of them, which is more evolved, will actually have that as well. Again, the base period, because these net zero targets again, if you look at it, basically what is net zero target is, you are reducing your climate, the burn or the degree centigrade that it's operating it by 1.5 degrees centigrade from a base year, which is from the industrial revolution days in the past. But I think we've crossed that limit. We will not at this rate at which we are all going, will not be able to reduce our reduce the overall degree centigrades of our weather by 1.5 degrees. So I think fundamentally there is, so a lot of companies have tried to use a base period to say, I will actually reduce my net zero. If I was at X emission norms on a particular date, which is a base year, this is 4 years before, even with having regard to future business of mine, I will either at an absolute level or at a relative level bring my emissions down to by a particular percentage. So it could be either a percentage based reduction that they may promise, or they could also be at a intensity, actual per unit base level also. So targets can be set in different periods, but they need to create a base, because you have to say I'm going to come down by so and so, means then you have to say from which year. So that base year has to be clearly called out. And then any milestones and interim targets, what are they set for those, all of those also need to be kind of called out. And again, there are different agreements that are being formulated by different bodies. Yeah. But you can please sit. Please sit.
Companies operating on sustainability. So, is there any scope of incentivizing them, like carbon credits?
Yeah. That is there. So today there is a voluntary market for carbon credits and all of those. So there is a trading market. I think even internationally there are markets which are available. India has also come up with a voluntary trading. I think there are regulations which have come up in the recent past in terms of carbon credit, but it's evolving. It was there earlier, long time back, then it kind of got dispensed with. It's again coming back in terms of green credits and all of those. So there is clear incentivization that is happening even in India, across the globe as well. And then review and monitor the progress against target. You have to call it out. Trends of analysis of trends and change in performance, gross GHG target, and planned use of carbon credits. So to your point in terms of carbon credits, I mean, if they plan to use it in a different way, then what are the offsets they have and how do they want to use it, all of those. So these are the disclosures that are required in terms of net zero targets when following S2 standard. Okay, this is effective from 1st of January 2024. And so in the first year, they can only report on climate-related risk and opportunities. And so to the extent if they don't want to talk about some of the other sustainability-related risks and opportunities, they can still stick to climate-related from S2 standpoint. So that is an, shall I say, a transitional adjustment or a concession that has been given. So, but if you were to do climate risk and opportunities in year one, when you do, so you won't need a comparative for those. But however, in this next year, you will, if let's say company moves to sustainability risk and opportunities at the overall level, for these you'll have to give a comparative, for the other one you may not need. So, in effect, if you see, obviously, from a disclosure standpoint, there is a conceptual foundation in terms of some of the basis for which you have to prepare. The disclosures are driven by these. Then there are some general requirements, and then there are judgments. So effectively, these are the four, I would say, aspects that cover most of the aspects of sustainability disclosures. And then climate-related disclosures, again, it goes into the four pillars where you look into it and evaluate in that context. So this is in summary. And then in a nutshell, if you were to see, as I said, these are based on TCFD. There are, as I said, interoperability, because there's an MOU signed between ISSB and GRI. There is an interoperability that we are reporting with GHG emission reporting. Then there is SASB standards, which are standards relating to specific industry. Then there is a CDP now, which incorporates topics aligning. So there's a lot of confluence of different regulators and standard setters trying to ensure that there is a lot of synchronization and consistency between different standard setters, and then you don't end up disclosing too many things in a different way. So that's still work in progress. It is still happening. So what are the expectations and impact? I mean, if you look into it, as I said, there are three key standards. One is the IFRS, next is the CSRD, and third is the SEC. SEC is a bit in abeyance because it's been challenged in the courts in US, so it's not necessarily seen the light. But there were, again, the SEC MSA was also more focused only on climate-related disclosures. It had the climate risk, and then again it was consistent with TCFD requirements in terms of climate risk-related disclosures, climate risk-related and its impact on financial statements, footnotes to be given in the in the 10K filings, in the financial statements, to talk about operating and capital expenditure relating to sustainability-related, climate-related initiatives. So those have been challenged, and then these are also subject to assurance over a period of time. CSRD, of course, is really if you go anywhere in Europe and you speak to any of those companies, this is in their topmost priority given the extent of work they have to do. So there's a lot of opportunity for professionals to help companies, and it's just not Europe. What you should bear in mind is, let's say there's an European company which has got a subsidiary here, and that European company is subject to the thresholds that are called out in the CSRD, because first is obviously the public interest entities, listed entities that kick in from which should have already reported last year, or 24. This is 24, which they reported 25, and Jan to December 24, reported 25. Then there's this large undertakings or large groups, which again are driven by those thresholds of revenue, net assets, and employees. So if those meet the criteria and they have subsidiaries in India, those subsidiaries will also have to provide those information for the global consolidation. So there's an opportunity to kind of work with some of these companies, check with them if you are actually auditing some of them or advising some of them, to see whether those will have to provide the relevant information. They may not be too proficient or aware of some of the requirements, so it's a good opportunity to read up and provide support. And so these are largely the three prevailing standard setters which are calling the shots from a global standpoint. Obviously, there are still in works in terms of some of the work plan where I think beyond the climate, they're looking at some of the things like biodiversity, ecosystem, and human capital. Because human rights and human rights diligence, due diligence, has become a very, very important aspect of international reporting today. If you see, Germany has come up with a law on human rights due diligence. When I say due diligence, basically evaluating whether there is a good work-life balance, workplace environment adequacy, forced labor, or slavery, modern slavery as they call it, where in the past, I don't know whether it's still happening now, it may not happen, but it may happen in pockets, I don't know. There are times when people used to go to Middle East not at a very high professional level. Their passports were actually taken out by the contractors who were taken. So those are typically forced labor. Then you're not actually giving them the right or the freedom to operate in the manner they should operate with the level of comfort. So those are all clearly called out in some of the diligences that you have to do. So human rights is another topic which is really caught on, just like climate, and that is something that a lot of companies are looking at. And of course, IFRS 1 and 2, we spoke about it. It's voluntary. As you see, there are so many countries which have already taken it on board. This is on January 24th, but I'm assuming Singapore did post that. And so the intention obviously is to deliver a comprehensive standard and reporting from a disclosure standpoint. So these are some of the things that are happening, and we will have to watch this space in terms of continuous improvement. From a company standpoint, obviously convergence of standards, companies have to go through the process to see what's best for them, what's right for them, what's more topical in the context of the regulatory environment in which they operate, the countries in which they operate, and what makes more sense for them to report, and who are the stakeholders who will be reading those reports. I think becomes relevant. And historically, if you see, we had these two standards. Sorry, I don't know why it's coming up differently here, but there was this ISA 3000 revised and ISA 3410, and we have an equivalent in Indian context. If you see, a lot of the BRSR reporting would have been on SA 3000 and SA 3410. A lot of companies, auditors would have assured on, they did the reasonable assurance on these two standards. These have now been consolidated into ISSA 5000. It's a very comprehensive standard. Going forward, this is the one that's going to be used by companies. Of course, we will have to evaluate and see. The institute has to come up with guidance in terms of what they're going to do in terms of embracing the equivalent of 5000. Is there a task force that's looking at it? But as it stands today, we do SAE 3000 and 3410, which is not, which is a converged standard. There's not much of a difference between. I don't think there's any difference between the international standard on that one. So assurance is not far off, because all the barring, of course, the IFRS standards don't call out for assurance requirement, but if you look at your CSRD or ACC or BRSR, all of them have assurance mandate. CSRD has limited assurance 1 year down the line, ACC also had a limited assurance 1 year down the line, and likewise BRSR is already having a reasonable assurance in that regard. So this is more in terms of the big three. I mean, it kind of calls out some of the other sets of people. This is what I said. SEC is more from investor perspective. This is more capital markets. IFRAG is more different stakeholders. So each of these standards are catering to different requirements. Concept of materiality, I mentioned about the double materiality, which is a very hot topic if you're doing a CSRD engagement today. It talks about, when say double materiality, is nothing but impact materiality and financial materiality. It's an intersection of both, or it could be even either of them, which may have the impact on the company. Impact material is based on, it's like an insider or an outsider. Impact materiality is more to say that if a company is operating in a particular segment, whatever operations it does, how does it impact the society? You need to assess that and then call it out. Financial materiality is outside. Whatever is happening in environment and other aspects, outside the company, in terms of drought and in case of water shortage, how does it impact the company? The financial impact of that. So it is a bit iterative in that sense, unlike ISSB and SEC, which clearly talks about financial materiality, and that's what you look into. And the standards are 12 standards, there are 2 standards, and there are rules here. These are largely driven by GRA and TCFD. This is a bit of IFRS, TCFD, SASP and GRA, and this is TCFD. Of course, there are applicabilities depending upon the requirements of respective locations and geographies. We'll touch upon that as well. Of course, there's a gap assessment. I mean, you need to do a lot of these. I mean, companies will have to do a lot of work in terms of taking stock of these standards and looking into what is the gap and how do they bridge these gaps as they kind of start working on it. That's largely it in terms of S1 and S2 and the way forward. If there are any specific questions, happy to take them.
So I know you said S3 is the most difficult one to do, scope 3, but would you have any thoughts on where we could learn more? Like I've been involved with carbon accounting. I'm working with a software company.
Okay.
We have done scope 1 and scope 2, which is pretty easy as you said, and we are trying to do something with scope 3. We are looking at capital equipment purchase and other value chain related emissions. But it's extremely difficult because they don't, like you said, they don't maintain enough data to ascertain anything, and it's very difficult to. For capital equipment, it is vastly different for furniture or for a laptop. So it's very difficult. So do you have any baseline or where I could read more?
So you can, ma'am, actually, some of these, you can actually look into this GHG protocol on accounting. That could actually give you a good base also. And then some of these are again driven by some emission factors. Once you start doing this, You have this IPCC or the DEFRA. These are largely used emission factors. But maybe a good start point will be the GHG accounting protocol. And then there's also GHG accounting, carbon accounting related, if you go to the GHG website itself, you will actually get these two. Maybe that will be a good start point to look into it as well.
Thank you.
Thank you for the wonderful session. It was so comprehensive and
Thank you.
very informative.
Thank you.
So, any suggestions on certifications or courses?
I think the institute itself has a course. I'm not too fully...
But honestly, I would say it is like, I would not, I've not seen employability or professional opportunities out of that. So,
a lot of them look into GRA certification as well, ma'am. I mean, there is this, GRA has a certification, they have these courses which they run. GRA certified professionals are regarded well from a reporting standpoint. I've at least seen GRA professionals more in terms of that. Because it again boils down to what line of work you want to, because if you're going to work more with advising clients on reporting, compliance, some of this will be a good thing to work through. There are also other courses, but I don't know the viability. Some of them say there's this Harvard course and all those stuff, online courses I mean, but I don't know the recall value of those. But GRA certainly I've seen a lot of recall value, because that's one thing that people look out for.
This concept is per se very progressing, and a lot of things are yet to come. But still wanted to know.
Sure. And the other thing is, the best thing is to, there are, of course, GRA will help. On the job is the best thing. I am not certified on anything actually. Although I aspire to become a GRA certified trainer at some point in time. I have registered, but I have
you have all comprehensive knowledge without it.
Actually, I've been working on it for some time now, so I've kind of gathered whatever I could in the last 3 years. But there's a lot more to. I've been scratching the surface. There's a lot more that I have to learn myself, because the fundamental reason is we're all accountants. So a lot of this is also intrinsically linked to science, emission, conversion factors. And then after a point in time, in the 4 walls, I switch off as well when my team also discusses with me or we discuss on some of these things. Because the last thing I did was to run away from science when I was doing my school, and then life has come a full circle and I'm now back to science. So.
Most everyone.
Sorry.
Thank you.
So, are there any relevant accounting standards like Ind AS or IFRS which talks about carbon credits?
So you can look into carbon credits. See, typically there have been position papers on carbon credits in the past.
Note is there, but I don't see any IFRS standards.
So it will typically follow. A lot of times accounting follows whether it is a right or not. Is it an intangible or is it an inventory? Because you're trading. So there are guidances in the past in terms of how do you look into it, even under US GAAP and under IFRS, whether you take it under Ind AS 38 or 36, is it? Okay, 38 or the Ind AS 2 in terms of inventory accounting. So it's a combination of those depending upon how you look at it. So there's nothing specific like a guidance note that the institute had for carbon credit, but even in the institute's case, it would either call it out as an inventory or intangible depending upon how you view it. It's more or less a borrowed thought in terms of how the accounting happens.
Arun, how is the market per se here? Apart, you were mentioning that the boards have started talking about it.
Yeah.
So listed clients, yes. But what about other companies, promoters?
That's a good question. See, typically what's happening is the listed companies are mandated to report on many things. And that's where the value chain becomes very important, because what happens if, I'm just making up an example, let's say if Hyundai is now listed and if Hyundai has to report on certain things because they may be in top 150 by market cap. So if Hyundai has to report on, because they are top 150 by market cap, and they have to also do a value chain reporting, because top 250 companies from in the current year 2025 have to report on value chain also, their value chain. So which means then they may have to reach out to all the tier 1 manufacturers who are private companies. So while private companies may not have the obligation to report in a particular format, or they may not be interested to come up with a sustainability report for obvious reasons or their own cost benefit reasons, But they are all now clearly mandated by the OEMs because OEMs are calling out their targets. So when they are calling out the targets, they also have to be dependent on their supply chain. If the supply chain does not, so there are something called as SBTA, science-based targets, SBTI. Okay, SBTI is an institution where you could actually go and do a science-based target to say that instead of arbitrarily saying I will reduce emissions by X value, you might actually go through a process and they will look into it and validate it, and then you actually call out a particular reduction. So a lot of OEMs are now actually insisting their key suppliers to take up science-based targets for their own operations. And so they're pushing it down because they cannot do that much to call out efficiency. So there is a lot of focus on companies upstream as well. And while they may not necessarily report out to the public domain, they are obligated to report to the OEMs. Be it in terms of particular formats that they are asking for, and now if value chain reporting is mandated in the BRSR, and assuming SEBI does not change anything as it looks at, because it's now looking to completely dilute what was asked for earlier. But if assuming for a minute you play along with whatever is available, this will be subject to limited assurance from next year.
Okay.
So which means the value chain data will be subject to limited assurance by the auditor. I don't know how they're going to do with all the parent auditor. At least parent subsidiary is okay. This is going to be of your supplier, so you may not even have access to supplier's records. And then the parent the company which is issuing the BRSR has to get the whole stuff subject to limited assurance. So which means I don't know, it will be back-to-back arrangement. So there are a lot of challenges, but to your point, there is clear focus that the supply chain is subject to some of these expectations and requirements, and so they've been working on it.
Okay.
So there is scope for everyone actually.
But these two standards looks like technical. It's not relating to accountants, as you said. Do you think that chartered accountants are really?
No, absolutely. You can see. I mean, once you start going through it, you will know it's not very difficult. You will figure. See, and again, a lot of this is narrative driven, right? I mean, if you read an integrated report, it's like reading a book nowadays, because companies want to make it more transparent to call out what are they doing in respect of each of the aspect of ESG. If it's wellness of employees, what are the things that they have done over a period of time, including setting up yoga camps or whatever it is. So you actually call out, it is not just PF, ESA anymore or gratuity, right? It is calling out all the initiatives that you're doing, how do you want to improve your wellness, all those. So it is not that difficult. I mean, once you start reading the fine print, you will know you'll be able to address it. Or you have to see two reports, what others have done to get a benchmark also. Great. Thank you. Thanks for your time. I know I started late, but I'm giving you half enough of your time, so
Thank you so much.
Thank you.